Welcome to our channel Edvantage. Learning made easy. Our previous video discusses the paper pattern of economics subject. The link for the same is available in the bio. Taking it forward, today we will start with the first module of economics, which contains Chapter 1 Commercial Policy. So let us begin. The chapter contents include three main headings, which are commercial policy, trade barriers, and protection techniques. Commercial policy is divided into meaning and various types of commercial policy. Trade barriers are further divided into two types, that is, tariff barriers and non-tariff barriers. Protection techniques include dumping, export subsidy, cartels, and commodity agreements. What is the meaning of commercial policy? Commercial policy or trade policy includes all measures regarding all international economic transactions between the reporting country and the foreign countries. What are the types of commercial policies? First, we have free trade policy. It is a trade policy which does not place any restriction on the movement of goods and services between countries. It does not favor domestic goods or impose extra duties on foreign goods. Next, we have protection policy. Protection policy means safeguarding the home country from foreign goods by erecting a strong tariff wall. It includes import substitution and export promotion. Trade barriers are the restrictions imposed on imports and exports. For example, taxes and duties. Trade barriers are further divided into tariff barriers and non-tariff barriers. What are tariff barriers? Tariff is a tax imposed on import or export of goods. Government may impose tariffs to raise revenue or to protect the domestic industry from foreign competition. For example, when government imposes anti-dumping duty on Chinese products imported in India. Main causes for imposing tariff barriers are: protecting domestic industries, protecting domestic employment, promoting R&D, national security, conserving foreign reserve, safeguard from dumping, balance of payment position favorable, raising revenue for government. Types of tariff barriers. The tariffs are divided into various types based on 1. Origin and destination of goods. 2. Qualification of tariff. 3. Application of tariff between different countries. 4. Purpose of imposition. We shall now discuss them in detail in the subsequent slides. Tariff barriers based on origin and destination of goods. Import duty is a tax imposed on commodity originating from abroad and imported by duty-levying country. For example, India levying import duty on goods imported from China. Export duty is a tax imposed on commodity originating from duty-levying country and imported by foreign country. For example, India levying export duty on goods exported to China. Transit duty is a tax imposed on commodity crossing the national frontiers originating from foreign country and imported by another foreign country. For example, transit duty is levied by India on goods which are originating from Sri Lanka and imported by Nepal, which pass through national frontiers of India. Tariff based on qualification of tariff. Specific duty is a fixed fee levied on one unit of imported good. Ad valorem duty is tariff levied on good based on a percentage of that good's value. Compound duty is when a commodity is subjected to both specific and ad valorem duty. Tariff based on application of tariff between countries. First, we have single column tariff. It is a tariff when uniform rate of duty is charged on all commodities. Next, we have double column tariff. It is a tariff when different rates of duties are charged on different commodities. Tariff based on purpose of imposition. Revenue tariff is a tariff imposed by the government when the main purpose of government is to obtain revenue. The rate of tariff generally remains low, otherwise imports will be curtailed and government will not be able to raise enough revenue. Protective tariff is used when the main purpose is to restrict imports into a country so as to protect the domestic industry. These kinds of tariffs are used by developing countries in the world. Countervailing duty is imposed on imports when these items have been subsidized by foreign countries. Anti-dumping duties imposed on imports when foreign goods are dumped in the domestic market. Effects of tariff are as follows. 1. Consumption effect. 2. Competition effect. 3. Revenue effect. 4. Redistribution effect. 5. Income and employment effect. 6. Price effect. 7. Protection effect. 8. Terms of trade effect. 9. The balance of payment effect. What are non-tariff barriers? The measures which are used other than tariffs to restrict imports get collectively referred to as non-tariff barriers. The various types of non-tariff barriers are as follows. 1. Specific limitations on trade. 2. Customs and administrative entry procedures. 3. Standards. 4. Government participation. 5. Charges on imports. 6. Others, which is further divided into A. Licenses. B. Quotas. C. Voluntary export restraints. D. Embargo. E. Standards. These are briefly discussed in the next slide. Licenses requires a state to issue permits for foreign trade transactions of import and export, which is included in the lists of licensed merchandise. Quotas, limitation in value or in physical terms for certain period, quantitative restrictions. Licenses and quotas limit the independence of enterprises for entering to foreign markets. Voluntary export restraints, restriction on quantity of goods that can be exported. The significance of voluntary is that such restriction is because of request of the importing country. Embargo, specific type of quota imposed on particular goods, regardless of destination, supplied to specific countries. Introduced for political purpose which may have economic consequences. Standards, countries impose standards on classification, labeling and testing of products to sell domestic products as well as block sales of products of foreign manufacture. Let's come to last part of the chapter. Protection techniques. There are 4 types of protection techniques. 1. Anti-dumping. 2. Export subsidies. 3. Cartels. 4. Commodity agreements. One. Dumping. Dumping refers to sale of goods abroad below the price charged for same goods in the domestic market or at a price below the cost of production, usually with the aim of driving competitors out of the market. Dumping can be explained easily with the help of following example. Sale of one television in China is at Rs 12,500. Whereas in India the same television is sold at Rs 10,000. In order to dump television in Indian markets, Chinese company would now sell one television at Rs 8,500 in India. Thus, Indian customers would prefer buying China television at Rs 8,500. Objectives of dumping. 1. To grow and expand industry of business. 2. To find a place in the international market. 3. To sell surplus commodities. 4. To develop new trade relations with the other nations of the world. Types of dumping. A. Sporadic dumping. Occasional sale at below cost to unload temporary surplus. B. Predatory dumping. Sale at below average cost to derive foreign producers out of market. C. Persistent dumping. Continuous tendency of a domestic monopolist to maximize total profits. Anti-dumping measures. Anti-dumping is a measure for protection of domestic industry. It provides remedy to the domestic industry against the injury caused by unfair trade practices. Measures adopted to prevent or stop dumping include tariff duty, import quota, import embargo. Continuing the example discussed earlier. In order to protect the domestic industry from dumping, the government can impose anti-dumping duty so as to make the imports more expensive and encourage sale of domestic goods. 2. Export subsidy. It is government policy to encourage export of goods and discourage sale in the domestic market. An export subsidy reduces the price paid by the foreign importers, which means domestic consumers pay more than foreign consumers. The most common product groups where export subsidies are applied are agricultural and dairy products. One of the main export subsidy programs in US is called Export Enhancement Program, EP. Effects of export subsidy. There are effects of export subsidy on the basis of country, which can be either exporting or importing country. 1. Effects on exporting country consumers. Due to increase in the exports because of export subsidy provided by the government, there are less goods available in domestic market, which leads to increase in domestic price and consequent reduction in consumer surplus. The reverse happens in case of importing country consumers. That is, increase in imports leads to increase in well-being and reduction in their domestic price and consequent increase in consumer surplus and their well-being. 2. Effects on exporting country producers. Producers start exporting their goods as a result of export subsidy, and thus it results in increase in producer surplus. The reverse happens in case of importing country producers. 3. Effects on exporting country government. The government pays subsidy which comes out of general government budget. The same is recovered by way of tax revenues, resulting into reduction in national welfare. There is no effect on the importing country government, except that there is increase in national welfare. 3. Cartel. Business agreement, whether formal or informal, that serve to limit or suppress competition are referred to as cartel. International cartels are sort of monopoly combined to eliminate competition in the foreign markets. Conditions conducive to international cartels. Number of producing firms is small. Firms have already reached cartel agreements between different countries. When process of manufacture can be patented. When there is government cooperation or leadership in the organization of cartel. The merits and demerits of cartel listed below. Four. Commodity agreements. An undertaking by group of countries to stabilize trade, supplies and prices of a commodity for the benefit of participating countries. Such agreements are international agreements designed to stabilize commodity prices in the interest of producers and consumers. Often producers of commodities will cooperate together in an attempt to introduce more stability into the markets. There are two types of agreements which can be entered. Production quota system. Buffer stock system. Types of commodity agreements. A. Production quota system. B. Buffer stock system. Objectives of production quota system. To limit the amount supplied to the market. To influence the market supply and price. To produce only within the quota. To reduce the quota with the intention to prevent the falling price. Buffer stock system works as under. Government sets a target price/price band. If surplus is produced, buffer stock authority will purchase the same at intervention price. If shortage, then stock authority will release the previous bought stocks to prevent price rise in market. Thank you for watching our video. Stay awaited for our next video and please subscribe to our channel Edvantage.